Bill Maris is a managing partner at Google Ventures. Bill, welcome to Bloomberg West, and you actually started Google Ventures.
I did. Thanks for having me.
So, just to clarify, what is the relationship between Google and Google Ventures?
It's the same relationship as an LP has with any other venture fund. We're a separate entity. We have one limited partner that supplies our capital, and that's Google. That said, it's a very influential limited partner. Virtually everyone on the team worked at Google prior, so we have a very close interaction tie to Google.
So are you looking at companies that Google might want to acquire for the business or even talent?
Google's appetite for acquisitions is large. We don't track that very closely. Our job is to find great companies to invest in, and some of those companies Google may want to acquire, but frankly, that's up to the entrepreneur at the end of the day. And so it would be his or her call whether to go the M&A route or to raise money.
Now, as I mentioned, the VC industry is going through a lot of changes at the moment. How do you see Google Ventures, which is kind of a different breed, potentially disrupting the status quo?
No, it's a great question. Frankly, the more things change, the more they stay the same. Our mission is to find great companies, do due diligence on them, and then do everything we can to help them succeed. And that means using the resources at Google to help those companies get to the next level. But that's been the core of the venture business for the last 30 or 40 years. And when folks have strayed from that model and simply wanted to write checks, that's when things go a little bit haywire.
And some of those resources include engineering and talent. Do you ever send applicants to Google over to the Google Ventures portfolio companies?
Absolutely. We are just sort of exercising that muscle, scratching the surface of the resources at Google that we can deploy to the portfolio. One of the key differentiators is the ability to use the engineering and recruiting technical resources to find and place technical talent and engineers at our portfolio companies.
All right, I want to bring in Cory Johnson now, who's been covering venture for a long time and been covering Google since it began. Cory, your thoughts?
Yeah, I wonder, when you look at the venture capital landscape, a lot of companies, notably Intel, have been out there investing in all kinds of deals in the venture arm. What do you do to try to, it's nice to say you want to be focused, but what do you do to maintain that focus and only be in the few deals that you want to be in?
It's a great question. Our objective as investors is to generate financial return. Different corporations have different objectives for their venture operations. Some want to help the LP or the parent company sell a product or service, but that's not our objective as investors. We try to keep our incentives aligned with our LP and with the entrepreneurs, which is to generate financial return first, which is very closely tied to the amount of value you create as an investor.
So how does that differ from other kinds of investments? And why wouldn't you just bet on commodities or trade stocks? Like, what is it about venture that's so appealing as a way to achieve those returns for Google?
So Google is a very entrepreneurial company with a culture centered around entrepreneurship and innovation. It obviously started by Larry and Sergey. Chad and Steve from YouTube are other good examples. There are many companies that Google has acquired which have brought in entrepreneurs into the ecosystem, and Google's always had an appetite to try and fuel innovation and entrepreneurship, and it's not like trading commodities. Basically, the first couple steps in investing, finding companies and deciding to invest in them, takes a relatively short amount of time. But the process of helping a company grow could take many years, and it's very different than public market investing, for example.
Well, does that mean that you want to stay ahead and be really early as a seed investor as opposed to a later stage investor?
Yeah, I think you'll see the majority of our investing activities are focused on seed, early stage, Series A types of investments. We certainly have a number of later stage investments, but the objective of our fund is really to find disruptive technologies early on.
When you look at, there's been a lot of talk out there about valuations, Facebook, Twitter, sky-high valuations. Do you think they're high?
Valuations are only high relative to what the ultimate exit is. So there's a difference between high-priced and a big number. And I'm concerned that in some cases, I won't talk about those specific cases, but in some cases there does seem to be an irrational kind of exuberance around some companies, and it's really hard to say.
You guys have been around for 3 years. The secondary markets have really kind of ramped up in that time. How has that changed what you're doing?
It's another avenue to invest in companies. generally we like to invest where we're supplying capital and buying shares from the company. If you're buying on the secondary market, you're buying shares from existing shareholders and providing them a liquidity event, which makes you a shareholder, but it's not the same kind of early stage partnership that we as a fund are looking for.
Is there a bubble?
I think you're asking me that question, which probably implies you know the answer. The last time I was asked that question was 1999, so I'm concerned that there's a bit of frothiness, and not in all parts of the market, but I think those who say that there isn't, you should sort of ask yourself, do they have a vested interest in there not being a bubble, and were they responsible for the first?
So in what parts of the market are you concerned?
I think consumer internet companies, companies that develop applications that touch large numbers of consumers, tend to generate a lot of excitement because people can easily understand and touch those companies. And the LinkedIn IPO is a good example of a lot of enthusiasm and high expectations for what that company could be. But it's hard for any company to live up to those kinds of expectations. So that's where I see a lot, where I have some concern.
We've seen LinkedIn and then Pandora come out of the gate, but with two very different outcomes. Are you watching that, and what have you learned?
We certainly are watching it, but the IPO market should be seen as another round of fundraising for a company. It's not an exit, it's not an accomplishment. It is in a sense for the company, but it's not the end of the line. It's one more opportunity for the company to raise capital. So it's a step in hopefully a multi-year journey of a company's growth, and not kind of the end-all be-all, which is how sometimes it is talked about.
So of the many areas where Google Ventures is investing, what are you most excited about? What do you think are the best opportunities?
We get very excited about areas where there's a confluence between large addressable markets, potential for disruptive technology, and exciting entrepreneurs who have ideas that maybe haven't been tried before.
Okay. Bill Maris, very interesting. Thanks so much for joining us.
Thank you.
On Bloomberg West. We'll be watching to see where you spend that $100 million this year. And we've had a lot of your portfolio companies on, and they've been great.